Alright, good morning guys. So in this video I want to explain a bit more about what I look for on a chart. Because I spotted a very nice accumulation pattern. I didn't trade it because it doesn't fit with my rules, but it's a very clear example on a lower time frame of what I exactly look for. So let's dive into it. If you guys are familiar with my stuff, you know I always start at the daily chart by identifying important swing points to the market. To me, this looks like a daily accumulation pattern, but I won't get into that right now because it isn't really that relevant. But this is what is important to me. This swing point is quite important to the market because it caused this move to the upside, and once the swing point got hit again, you can see it broke, false breakout to the downside, and again a move to the upside. So I wanted to see what happens once this level gets hit again and gets broken again. I want to see if we could get a sign of a false breakout to potentially enter to the upside. And as you can see here, we again broke this low, but we closed above it. And that's a very telling sign because the liquidity that is below this range, so people that are long will have the stop losses below this range. People that want to sell will be selling a breakout to the downside. So this level breaks and people will be shorting, maybe looking for a retest to go short, and on a lower time frame we get that retest. So there is a lot of liquidity, and as you can see there's a strong rejection and a close above the level, which indicates to me that the liquidity that was available below these lows has been absorbed by a bigger player to fill his long orders, and that perfectly fits in line with the daily accumulation pattern. So I was very bullish. I already expected once this level got hit to see an accumulation range on a lower time frame and a long trade. So I've established a bullish bias. Next thing I do is go to the lower time frames. This is the particular level in question. Let me drag the line. So we were in a downtrend on the hourly time frame. This is a small distribution range. Got here the buying climax, etc. redistribution, and then we get this sharp move to the downside straight into this level and closing above. And this is very telling because if you are familiar with Wyckoff, this is a clear selling climax over here, and the selling climax is a strong move to the downside at the end of a downtrend, basically to attract people to sell. And after a selling climax, I want to see a change in character. I want to see a violent move to the upside, which is this. As you can see, within 3 candles, this move to the upside was created, and it also was after the swing low was taken out. So that's very telling to me. There's something up. Someone with a lot of capital is buying over here. That's the first sign to me. Then I want to see a range develop. So I want to see more people get into the markets to potentially go short, as they maybe think the market's running out of steam. We broke the swing low, so people are shorting. I want to see what happens to the liquidity at this important area on the daily time frame. Let me get back into the accumulation phase. So this is your phase A of the accumulation. Like I said, the selling climax and the move to the upside. And what's really important to notice about the move to the upside is that it's the most violent move to the upside since the entire downtrend, because this was the move down. And look at this, it's almost the same size, but this one is way quicker, way more aggressive. So this indicates to me that there's a big buyer. To make this accumulation pattern a bit clearer, I'm going to zoom in. Again, I don't trade the 50-minute time frame, but this was such a clear example of what I look for, so I wanted to illustrate it. If I fill in the Wyckoff schematics, this is the selling climax. It's the automatic reaction, the change of character, and this would be your phase. Your phase A. You usually get some secondary tests in phase A. In this case, it didn't happen. Your phase B is always the longest phase, which is this. And this is where the bigger player is accumulating his long position. So you will see him, first of all, he starts at the selling climax. He used the available liquidity to fill in a part of his long order. And then you will see up and down movement. So as you can see here, you really see a range developing. And what's important to notice is that this line, let me make it another color. This line over here doesn't get broken. You will see up and down movement, but this low doesn't get broken. And that's very important to me because there will be liquidity below this and also below these lows. And what I want to see is people get trapped selling the breakout to the downside. So as we have the bias from the daily time frame, we know that we are below the level, the daily level over here. We are below, so people will be selling. There will be liquidity below this blue line, and I basically want to see what happens in phase C. So during the false breakout phase, what happens? And as you can see, there is a very strong rejection over here. So this is what we call a spring for people that are familiar with Wyckoff, and this is your phase C. And after the spring is created, you basically want to see another change of character like we had in phase A. So another strong move to the upside to indicate that the liquidity has been absorbed. And we are now ready for another move to the upside. And that's exactly what happens. Look at this strong move to the upside after the false breakout of the low. It's very strong. It's very telling. And then it's time to search for an entry, and my entry is always at the breakout. Some people wait for a retest, I don't. So if I would have entered this on the higher time frames, because I trade this pattern on the higher time frames, my entry would be here and my stop loss would be over here. And then I would target a statistical based target on the higher time frames, but this is the premise. This is what I look for on a lower time frame when I establish a statistical bias on the upside on the higher time frames. So there's a couple of ways you can trade an accumulation pattern. I prefer to enter in phase D. So this is your phase C between these two red lines. Phase D is the actual breakout, usually a small consolidation at the breakout point. Which gives you plenty of time to enter in phase D, which is over here. And that's where I enter. I enter always in phase D. However, I do have a strategy with a lower win rate where I enter at the spring, which means my entry is at a better price, which is the close of the spring, and the stop loss goes below the low of the spring. But the chances of losing are higher because you don't have the confirmation of the change in character after the liquidity. There is a rejection of the lows. Yes, there is a rejection of the selling climax and the liquidity is absorbed, but you still don't have a follow through to the upside. And I always want to see this follow through to the upside and enter in phase D. But you can trade at the spring to get the best risk reward opportunities. It's totally up to you to find what you like and what fits with your personality. I like to enter the breakout because it gives me a higher win rate with the risk reward is a bit less, but the win rate on my trading is higher, and I like that. So that's how I trade these patterns. But there are a lot of ways to trade it. So to recap this, I started the daily, I identify important swing points in the market. I want to see a false breakout of that important swing point, and I want to see what happens to the liquidity that gets triggered below or above those swing points. And if I see an accumulation range at these levels, I try to enter at phase D to target a statistical target that I basically created with backtesting. So that's really it. You can also use a level to level approach, which I used to do in the past, but it was too much of a discretionary approach to me. But this is the first level above market, first resistance above market. So you could enter at the spring, target at that level, which gives you a 2.4 R, 2.3 R, which is decent if it fits with a good win rate. And then potentially you can re-enter if this level gets this level gets broken, to target another level. So for example, one of the approaches I use to trade with is to close at the first level of resistance. So that would be over here. This would be my target, and then I'll wait for the price to break and confirm above, and then I could enter a retest to target the next level. As you can see over here, this is the next level, to almost equal highs and resistance over here. So that would be the first, and then you can really enter a trend, because you have to remind yourself that the accumulation phase is the beginning of a trend. So you can potentially, depending on the location, capture a way bigger trend, and you can really pyramid into it. So your first entry is at the spring, your next one will be at a retest of the first level, your next entry would be a retest of this level. In this case, it would be small move to the upside, and it potentially could be a loser, but this is how you really can build a long position in the market. So I hope you guys learned a lot, and I'll speak to you guys next week.